Hey guys, what is going on? Welcome into the video. So this is going to be a fun one. Today we're going to be going through all of the mega cap tech companies and Apple, Microsoft, Google, Amazon, Tesla, Meta, and Nvidia, comparing these by fundamentals to see which are the best long-term buys in this group. So I hope you all enjoy. Make sure to hit that like button and subscribe button if you have not already. And at the end of this video, I'll be ranking these by my favorite buys to least favorite buys, 1 through 7. So now going ahead and getting into it, the first thing that we're going to be doing with these stocks is we will take a look at comparing the next 12-month / forward price to earnings ratio of each of these companies. And for those who are unfamiliar with this metric, it takes the current market cap divided by the earnings that companies are expected to make within the next year. So starting with the most expensive by this metric, we have Amazon with a 68 forward PE and Tesla with a 56 forward PE. So on first glance, these two look much more expensive than the others, but there are reasons for that we will talk about more in a little bit. They are actually much more attractive than some of these others. And below that next, we have Nvidia trading at about 27 times forward earnings, Microsoft at 26 times, Apple at 23 times, Google at 19.6 times, and Meta at 14 times the next 12 months earnings projections, which is currently trading the cheapest on a forward earnings basis by far. So now first off, getting into the first case study, we have Amazon stock, which as we talked about is trading the most expensive currently on a forward price to earnings basis at about 68 times. There are quite a few things to take into account with Amazon though, and is not one that can really be valued by this price to earnings metric. So in the past 5 years, there have been 4 dogs in the fight to become the largest company in the world, and it's been between Apple, Microsoft, Amazon, and Google. For a very short time period in 2020 actually, Amazon was actually the largest company in the world, but as we know, in that year a lot of growth got pulled forward, and since then it has lagged the others big time as it currently sits near 2018 price levels. I've talked about Amazon a lot in past videos and why I've been a buyer at current prices, so I'm not going to go too deep into the thesis in this one just for time's sake, but the Amazon business model is currently not optimized for profits. The company constantly reinvests back into the business for growth and is in currently one of the worst positions in 2022 due to the huge expense from gas prices and others, and you just really have to take a long-term view when investing in this company, but it's expected to have the largest profit growth of any of these companies in the next 4 years by a long shot. I put together this spreadsheet based on analyst estimates from 2022 to 2026 for revenue and earnings compounded annual growth rate. And as we can see, Amazon is expected to grow revenue at about 14% yearly and is expected to ramp up profit in a big way as well, and this time frame growing at an 82% CAGR. That number is skewed though, as in 2022 their net income is expected to drop 77% from 2021's numbers. So I actually added another column for Amazon to show the CAGR between 2023 and 2026, which comes out to a 48% CAGR between those years, so it's more normalized and easier to compare. So this just shows that even though Amazon looks a lot more expensive right now than others, seeing these side by side and comparing these metrics, it also has a lot more earnings growth in the coming years that it will hit. For investing in Amazon though, there's a few questions that you have to ask yourself. First off, do you trust management to execute better in the coming years? Because ever since Andy Jassy has taken over as CEO, the execution for this business has not been good at all. So you have to trust in the management to turn this business back around and hit those future projections. Also, do you believe that e-commerce will get back to steady growth after this massive 2022 slowdown? And finally, do you believe that the AWS cloud business will continue the massive profitable growth, which is my personal largest bullish thesis on Amazon, in which AWS is by far the market leader in an industry that has essentially like unlimited growth ahead, especially within the next 5 to 10 years. Next up, the company that is second most expensive on a forward price to earnings basis, as we talked about, is Tesla stock with a forward PE of 56 currently. Last week I made a full video on all of the risks with Tesla stock along with the bull thesis, so if you're interested, make sure to check that one out. But at the end of the day, in my opinion, Tesla is the highest risk and highest reward of all of these mega cap tech companies. Taking a look at the consensus analysts' revenue and earnings growth estimates, it is way lower than the numbers that those who are very bullish on Tesla are estimating. So if Tesla ramps up the factories, solves self-driving, gets the robot business underway, etc., they will no doubt absolutely blow these analyst estimates out of the water and easily have the best returns in the next 3 to 4 years out of this group, in my opinion. Though there's also some major risks in the business model, such as they're making all of their profits in China currently, the auto demand is starting to slow down, and more that we talked about in last week's video. Tesla is no doubt the most polarizing name out of this group though, and there are just so many different opinions on this one, with some expecting the stock to crash more massively from here, and some expecting it to triple within the next couple years. In my opinion, it is certainly not easy money here because it does carry some major risk from all of the unknown, but it definitely is the most exciting and has the highest upside of the rest of these companies. So getting into the next one now, this is Nvidia stock. So here's my opinion on this one. It is still pretty expensive. Nvidia essentially had the perfect scenario play out in the last 2 years with massive chip demand in all of the right industries, which is now starting to slow down in a trend that could easily continue within the next couple years. There's a ton of exciting aspects to the business model, such as their AI, data centers, and cloud, but when comparing it to its semiconductor peers, we can just see that there could easily be a lot more multiple contraction to come in here in a forward PE basis. It's also trading by far the most expensive in its industry, and while I agree it is the most exciting company out of these, it's also the largest and past its hyper growth stages. It could easily drop another 30 to 50% from here and still be in line with its peers, which is definitely worrying if you are trying to invest in Nvidia stock at current prices. So my thing is, why buy Nvidia at a 27 forward PE when you could buy AMD for a 17 PE, which is almost as exciting and just is an exciting company in the same industry as well. AMD has executed near perfection. There are also some crazy cheap semiconductors such as Micron, Qualcomm, and Intel trading near or below a 10 forward PE ratio. So there's some just great deals in this sector currently, and Nvidia does look expensive compared to these other names. So next up is Microsoft, which currently trades for about a 26 forward PE, which is certainly pretty expensive for its growth, but it's also expensive for a reason. There is almost no risk to Microsoft's business model. It can certainly slow down and miss estimates based on macroeconomic factors, but their cloud and software businesses are perfectly suited for the next 5+ years, along with the new growth avenue if the Activision buyout goes through. There's a great business model, great balance sheet, and should be around a 10 to 15% revenue and earnings growth moving forward with very little risk to these numbers, but the stock is just still pretty expensive at these current prices. Apple is next, the current largest company in the world. So here's my thing with Apple. In my opinion, this is the best managed company in the world, but it's just a very expensive stock. There are also risks with this current environment, such as it looks like we're going into a recession. Then the question is, how much demand will there be for $1,000 phones in this time period? Definitely a big question right there. So analysts expect about a 5.5% revenue growth through 2026 and 4.7% earnings growth. So at this point, Apple should essentially just be valued more kind of like a value stock. And with a 23 forward PE, it is just not yet at an attractive valuation. And sure, Apple could easily beat these analyst estimates if they come out with new unexpected products, get the Apple Card to production and more, but it's just an expensive stock currently in my opinion. Next up is Google, and this is trading at really attractive prices in my personal opinion. So it trades at about a 20 forward PE ratio, and analysts expect a 13.5% revenue CAGR through 2026 and 15.3% profit growth. So if you invest in any digital ad companies right now, I do think we should be expecting a slowdown in ad spend in the next couple quarters, which could lead to more misses on earnings. But after we get past these short-term macro issues, Google is in a great position. The company essentially has a monopoly on search. Their cloud business is not yet even profitable, and when that becomes profitable, it will be a huge positive to those earnings numbers. They have a killer balance sheet and so many other growth avenues to go down. So Google is just a very attractive stock at these levels in my personal opinion. And finally, getting into Meta stock. Now this is another polarizing one with a bunch of different opinions on it. We can all agree it's a super cheap stock right now, trading for a 14 forward PE. Analysts expect a 13.2% revenue CAGR and 15.1% earnings CAGR through 2026. And if they hit these numbers, this stock is an absolute no-brainer at current levels, but that is the risk if they're not able to get there. Like Google, their business is based on digital ads, so we should expect more of a slowdown this year, which could easily lead to more missed earnings, but the stock is already discounted for that and more in my opinion. The company just started to put ads into Instagram Reels, which will be a profit boost moving forward. They have a great balance sheet, and the market is pricing in nothing towards their metaverse ambitions, which if they execute well on can be massive. So the bare thesis is that TikTok is taking all of the market share, but in my opinion is that TikTok is more of an entertainment platform versus Instagram and Facebook being actual social platforms. The argument is that these social platforms do not really have a moat. I do think they have a very strong moat in that social aspect. Maybe it's not the best for entertainment like TikTok and YouTube have shown. They have a lead on that. But Instagram, Facebook, etc., these are the main social platforms, and I don't see that going away anytime soon. But TikTok has definitely been a massive negative for Meta and why this stock is so low right now. But the risk is just more than discounted in my opinion. And there is also articles like this coming out, so who knows? TikTok may not be a thing in the US forever, which would obviously be massively bullish for Meta stock. And also one of my biggest things on Meta is that Mark Zuckerberg has always grown and gotten the job done, and there is very little doubt that he will continue to do so with their current business and other growth avenues in the future. He's also only 38 years old, so this man could easily keep going for another 20 to 30 years, and as he talks, he sounds as motivated as ever right now. And no doubt top 10 CEO in the world, if not top 5. And love him or hate him, he's a genius, and this stock is very cheap. Alright, so now getting into the rankings in the order where I would personally be buying these stocks at, from most favorite buy right now to least favorite buy. And of course, this is my opinion, always do your own research. My number one at current prices would be Meta. It is simply just too cheap and has been too great of a business to be at 2017 prices and trading at the current multiple that it trades at. Next up, I'd put an Amazon with Google close right behind. And after that, in my opinion, there's a pretty decent gap in my view. The top 3 are all great buys right now in my opinion, and the next can be questionable at current prices. Next up in the attractive risk reward section, I have Tesla at number 4. Now it's not necessarily a no-brainer buy just due to the risks in my opinion, but it has a lot more upside than downside potential. And like I said, I think it has the most upside out of any of these names in the long term. Most exciting, most risky. I do think the risk reward is attractive though. After that, in the expensive section, I'd slot in Microsoft at number 5, Nvidia at 6, and then Apple at number 7. No hate on Apple, it's just really expensive for a company with less growth potential left. Nvidia is expensive compared to its industry and along with the headwinds ahead. And Microsoft is expensive as well, but that's just a bulletproof business model in my opinion, and it has a lot more growth potential left than Apple and less risk than that in my opinion. So that's my personal thoughts and opinions on 7 of the largest companies in the world and the ranking that I would buy them in. Let me know your thoughts in the comments down below, what you think I'm wrong on, what you think I'm right on, what you agree with, disagree, etc. Make sure to like button, subscribe button if I did provide some value to you, and I would greatly appreciate that. For anybody interested in joining the private Discord chat, that's the first link down in the description. You can get all my personal trade alerts. And thanks so much for watching, guys. Really do appreciate it. I will catch you all next time. Peace out.